Assalamu alaikum friends. Today's video I will be discussing change in the group structure. What happens when you acquire a subsidiary? What happens when you dispose of a subsidiary? What happens when the transaction, acquisition or disposal is in the middle of the year, right? So all those things I'm going to cover this, and this video is divided into two parts. This is the first part, and first part I'll be going through the concept. Second part I'll be doing all the questions, test your understanding and all questions relating to changing group structure. So let's start. Acquisition of subsidiary. It could be a mid-year acquisitions. It could be step acquisition. Step acquisition means when you're buying a subsidiary or an associate or whatever it is, not in one go. First you are buying, let's say for example you are buying a 60%, then you are buying again 20% of the same subsidiary. So how do you have to account for it? All those things. Mid-year acquisition, by the word you know that it is you are buying a subsidiary, okay, in the part way during the year. It could be any month, it could be four. So how are you going to consolidate if it's a subsidiary? You consolidate a subsidiary on a pro rata basis. Okay, you have to pro rata basis for the post acquisition income and expenses. So in your consolidated statement of profit and loss account, the income and the expenses from the subsidiary that you are writing, that you are adding with the parent, it should be on a pro rata basis. For example, you have bought an entity, okay, just 3 months before the reporting period. That means that entity is your subsidiary only for last 3 months. So when you're consolidating, the income and expenses you are taking are only for the last 3 months. 3 months of that expense and income you are consolidating, not the whole income and expense. So illustration is that this will be going in the second part of it. We'll be doing questions. Okay. Now step acquisition. Step acquisition occurs when the parent company acquires control over the subsidiary in stages. Okay. This is achieved by buying blocks of shares at different times. You're not buying together. You're buying step by step, and that step only happens twice. Okay. In the exam, they will not give you that you are buying 3 times. No, only twice. First time you are buying, let's say 60%, and second time you are buying 20%. So now that company is your 80% subsidiary. Okay, they will not give you more than 2 times. So acquisition accounting is only applied at the date when the control is achieved. That means you have to consolidate only at the date when the control is achieved. Let's say first time you have bought 40%. That time you cannot consolidate because at 40% it's an associate. But let's say you have bought 30% more later. So 40 plus 30 becomes 70%. Then at that time when you're buying the additional 30%, that entity becomes your subsidiary now. Then you have to consolidate. Okay. Any pre-existing equity interest in an entity is accounted for in account in two. These three things. Pre-existing means when you're buying, okay, before you are buying whatever is existing there. So it could be dealt using IFRS 9. Okay, that means from 1 to 19%. It is considered as IFRS 9. Let's say you have 10% interest. Now later you are buying 30%. So that 10% interest, before you bought that 30%, before it became 40%, that 10% interest you have to value it. Okay, you have to find out that value. What is the value? That's why it is known as pre-existing equity. It is, so it could be if it is from 1 to 20%, within 1 to 20%, it is done under IFRS 9. If it's more than 20%, less than 50%, it is dealt under IAS 28 as an associate. And if it is a joint venture under joint arrangements, then IFRS 11. Okay. At the date when the equity interest is increased and control is achieved. So you're increasing it because you are acquiring it. Okay, we are still didn't reach the disposal, so don't think about disposal right now. Disposal will be covered later after we finish acquisition part. And you are achieving the control. That means more than 50% you are reaching. What do you have to do? So these are the steps that you need to do, and make sure that you know the steps, because definitely you'll be asked a question which step acquisition is there. It's always asked in group accounting. So you have to remeasure the previously held equity interest. It could be anything. That previously held equity interest could be out of this three. If it's financial instrument, then IFRS 9 you have to use. If it's an associate, you have to use IAS 28. If under IFRS 11 is a joint venture, then you have to use IAS 28. Again, equity method, okay? But that has to be remeasured to fair value at the date when you are buying, when you are going for the second acquisition. Second, recognize the resulting gain or loss, okay? Because there will be a change in fair value, so you will be having some gain or loss. That gain or loss will be recorded in the profit and loss or in other comprehensive income. It could be recognized in other comprehensive income only if the shares have been designated to be measured at fair value through OCI. This can only happen when it's an IFRS 9. Under IFRS 9 only this can happen. Okay. Calculate goodwill, definitely, because you have achieved control means more than 50%, you have to calculate goodwill. And calculate goodwill and NCI also. That NCI you can measure using full basis, that means fair value or proportionate of net assets. That will be given to you in the exam, which method you have to use. Next. So for the purpose of goodwill calculation, the consideration will be the fair value of the, now when you are calculating goodwill, in the second time acquisition, because this is step acquisition. Remember, don't get confused when I say first and second time acquisition. So the consideration will be the fair value of the previously held equity interest plus the fair value of the consideration transferred. Okay, you just need to remember this. The consideration will be the fair value of the previously held equity interest. That could be anything, associate, joint venture, financial instruments. Okay, first that fair value plus the fair value of the consideration that is transferred for the most recent purchase. Recent purchase means the second time that you have purchased. So you have to add both and NCI also. Less fair value of net assets at acquisition. Okay. So this thing has changed. When first time when you're acquiring it, this thing is not there. It is just the fair value of consideration plus fair value of NCI minus fair value of net assets. But this time this is added here. When you're buying, this happens when it's a step acquisition. Okay. Second time you're buying. Next. Any gain on losses that are recognized in OCI from the remeasurement of any previously held equity interest cannot be reclassified to profit and loss. You cannot reclassify it. It will be there only if it's in OCI. Next. Purchasing further stakes in subsidiary after control has been acquired. For example, taking the group interest from 60 to 75%. When you have bought 60% for the first time, you have already acquired the control. It's a subsidiary. Second time when you're buying it, that means 15% more, it becomes 75%. So still control is retained. You still have that control and still it's a subsidiary. Okay. So this transaction is regarded as, it is not an actual an acquisition. It is regarded as a transaction between equity holders. That means your NCI reduced from 40% to 25% and your equity shares increased. Okay. You are just taking more shares from your NCI now from 60 to 75. That's it. So this is regarded as a transaction between equity holders. So goodwill you do not calculate. Goodwill is not recalculated. Goodwill you calculate only first time when you have bought the 60%. Second time when you are increasing it by 15%, you don't calculate goodwill. This situation is dealt with separately in this chapter. Okay. We have a rule for that also as well. Now, let us go to the disposal of a subsidiary. So that was about acquisition. During the year, one entity may sell Some. Okay, so disposal means it could be entire disposal, completely they are selling 100%, or partially they are selling 50%, 30%, like that. Okay, it could sometimes lead to loss of control, sometimes it's not lost to loss of control. What does it mean? Let's say you are having 80% now and you are selling 30%, you are selling 40%. So when you are selling 40, from 80 to 40 it becomes 40. That means you are losing control. Earlier it was a subsidiary at 80%. Now after disposing 40%, you are having only 40% interest. So it becomes an associate. From subsidiary to associate. So that is known as loss of control. There are some possible situations. So these are some possible situations how you can have a loss of control. First scenario, disposal of all shares. You're disposing completely 100% from 100 to 0. Second, disposal of part of the shareholding. Okay, you're selling not entirely, but when you're selling it, it reduces below 50%. So whatever is remaining, okay, it will be regarded as an associate if it's more than 20 and less than 50. Or it could be regarded as a trade investment. That means you have to deal it under IFRS 9 if it's less than 20%. But the accounting treatment for all these three situations are same when it's a loss of control. Remember that. Situations could be anything. You don't have to remember the situation. What you have to remember is it a loss of control or not? Same for the purchase, same for the disposal also. For purchase, you have to see whether it's a gain of control or not. For disposal, you have to see whether it's a loss of control or not. Because the accounting treatments are different when it's a loss of control versus when it's not a loss of control. Okay. So let's see. This is the disposal in the individual financial statements. Okay. In all of the above scenarios, the profit on disposal, when you're disposing, you'll be getting some profit. So that profit on disposal in the investing entities individual financial statement is calculated as follows. Make sure that you know the individual scenarios also. So individually it will be sale proceed at what amount you are selling minus the carrying amount of that shares that you have sold and profit on loss on disposal. But this is in the individual financial statements. Okay. Next. The profit or loss may need to be reported as an exceptional item. If so, it must be disclosed separately on the face of the parent statement of profit or loss for the year. If it is reported as a exceptional item, then you have to disclose it separately. Okay. On the face of the parent's statement of profit and loss for the year, it's parents, is individually for the parent, not for the group. We're not talking from the point of consolidation. Now, there must be tax to pay on this gain, depending on the tax laws in place in the parent's jurisdiction. This would result in an increase to the parent company's tax expense in the statement of profit or loss. So these things are not so important because rarely they ask the individual financial statements from the parent's point of view. But if they ask, you should know that if there's a gain, you have to pay tax. So because of that tax in the parent's company, tax expense will be higher in their statement of profit or loss. Okay. But for us, important is in the consolidated financial statements, what is the impact of this disposal? If this are all what you have to do if the control is lost. Okay. Is lost means less than 50%. After you're disposing it, it becomes less than 50%. How you have to treat this? And make sure that you remember these points. Definitely you will remember these points better when you do a question, when you try to understand through questions how to solve. You have to calculate income and expenses of the subsidiary up until the disposal date. You have to calculate the income and expense of subsidiary. Why? Because you have to consolidate. But when you're disposing it, the day you're losing the control, from that day onwards, you are not consolidating anymore. Okay. On the disposal of the subsidiary, since you are losing the control, this is only when you're losing the control. That means it's no more a subsidiary. What do you have to do? You have to de-recognize live assets, de-recognize liability of the subsidiary, the goodwill, the NCI, all this you have to de-recognize and calculate what? Profit and loss on disposal. Okay. Next. Recognizing any remaining investment in the shares of the former subsidiary at fair value. So if there is any remaining investment in the former subsidiary, that means before losing the control, that has to be at fair value. And subsequently account for this under the relevant accounting standard. if the holding is between 20 to 50%, what happened? It would probably mean that the remaining investment is an associate. So if it's an associate, you have to use equity accounting. Okay, the remaining, after you have disposed, whatever is remaining, you will treat it as an associate using, and then you'll be using equity method. Okay. Next, if it's less than 20%, then the remaining investment will be treated under IFRS 9 financial instruments. So where the control of the subsidiary has been lost, the following template should be used for the calculation of profit and loss and disposal. Make sure that you follow this template. Okay, you will need this. It's very helpful. You will never make a mistake if you follow this template, even on the exam also. This is for calculating profit or loss when you're disposing. Disposing only when you have lost the control of the subsidiary. When the control is still retained, then you should not use this template. So first is the disposal proceed. From there, you have to add the fair value of the retained interest. Okay. Next, you have to deduct this net assets at the disposal date. Goodwill. This you add and deduct from there. Make sure that you have two columns like this, and in the inner column you are doing this. Okay, adding this to and deducting carrying amount of NC at disposal date, and then finally you deduct this one from this, and then you get a profit or loss to the group. Now, presentation of disposed subsidiary in the consolidated financial statements. How are you going to present this? Now there are two ways of presenting this. Number one is, first method is known as time apportioned line by line. Okay, so in the consolidated statement of profit or loss, income and expense of the subsidiary are consolidated up to the date of disposal. Okay, so in that way it's easy. And the traditional way is to time apportion each line of disposed subsidiaries results. Time apportion means if it's, let's say for 6 months they have been a subsidiary and 6 months they are an associate. So you will only take 6 months of all the income and expenses and add with the parent. The profit or loss on disposal of the subsidiary would be presented as an exceptional item. Okay. Second is discontinued operation. So if the subsidiary qualifies as a discontinued operation in accordance with which standard? IFRS 5. Not all subsidiary when you are selling are discontinued operation under IFRS 5. No. It has to satisfy some conditions. It have to satisfy the conditions of IFRS 5 to be qualified as discontinued operation. Then only you have to go by the second method. Okay. Then the results are aggregated into a single line on the face of the consolidated statement of profit or loss. What does it mean? One line, single line will be there just to show profit or loss from discontinued operation. Okay. And this comes right after the profit for the period from continuing operations. Immediately after. You see, it is immediately after. You should know where exactly this is located. So it is written right below after you write profit for the period from continuing operations. Okay. The single figure compromises two things. One is profit or loss of the subsidiary up to the disposal date, and profit or loss on the disposal of the subsidiary. So up to the disposal date. Okay. So if you are using the first method, it will be this one. Up to the date of disposal date, the profit or loss. If I are using second, discontinued operation, then it is this one. Profit or loss on the disposal of subsidiary. Now we are going to the second type of scenario where control is there. Whether you are buying, whether you are selling. Control to control. It is known as control to control scenarios. Share purchases have led to control over another control being obtained. That means from 60 to 80. You are going from 60 to 80. At 60% you had control, at 80% also you will have control. Or let's say you have 80%, you have sold 20. So from 80 to 60, still you are having control. You are not losing control. So it could be purchase or sales, but in any case, control is retained. Okay. Now, how are you going to deal with the situations? This is known as just you are just increasing the entity shareholding. That's it. This is not even this is not even taken as a purchase or a disposal. Okay, it's like increasing holding from 80 to 85, or if it's a sale share, you are selling shares, then from 80 to 75. Okay, they will be subsidiary in both the scenario, whether you're selling, whether you're purchasing. When the control is retained means they are still a subsidiary. Let us consider this in more depth. When shareholdings are increased, okay, this is not even treated as an accusation in the group financial statements. Because it's just like parent is having 80%, now they are buying 5% more from the NCI and becoming 85%. So NCI is reducing, equity shareholding is increasing. So it's more like a relationship that is between the parent and the subsidiary, right? It remains. But NCI has decreased. So you have to find that decrease in NCI now when control is retained. When it's an accusation, NCI has decreased. When it's a disposal, NCI has increased. Okay, that increase or decrease only you have to find. That's the only thing. Rest all everything is same, whether disposal, whether accusation. So NCI within equity decreases. That decrease you have to find out. Because shareholding increase means NCI will decrease. So the difference between the consideration paid for the extra shares and the decrease in NCI is accounted for within equity, normally in other components of equity. Difference. So you have to find the difference between these two. Between the consideration paid for extra shares, that means second time when you bought, the consideration that you paid, that consideration you have to take, not for the first time. And the decrease in NCI. How much NCI decrease? It will be accounted where? Within the equity. And it will be recorded under other components of equity. Note here, very important, very, very important. When control is retained, that means no control is lost. There is no profit or loss. Because you're not selling, no? You're not selling to another party. Subsidiary remains subsidiary, so no profit or loss. They're in the same group still. So here, goodwill is also not recalculated because both are, they are still subsidiary. First time also, second time. So second time when they are subsidiary, you don't have to recalculate that goodwill. So goodwill is not recalculated. Okay. And make sure that you learn this pro forma to calculate the adjustments that are required to NCI. Okay. Cash paid. Definitely you'll be paying additional cash to buy that additional share. So that is credit. And NCI will decrease. So it's debit. Okay. So that decrease in NCI you have to find out, and then you will be minusing it from the consideration that you have paid for additional shares, and the amount that is known as, it could be decreased or it could be increased to other components of equity. Okay. Next. So the decrease in NCI will represent the proportionate reduction in the carrying amount of the NCI. How are you going to calculate the decrease in NCI? Will represent the proportionate reduction in the carrying amount of the NCI at the date of the group's additional purchase of shares. We are definitely going to show this, okay, through a question, how to find that decrease in NCI. For example, if the NCI shareholding reduced from 30 to 20, okay, then the carrying amount of the NCI must be reduced by 1/3. How did they get 1/3? How did they get 1/3? It is simple. Find the difference between these two. 30 minus 20, 10. 10% divided by the old NCI, which is 30. So 10 divided by 30. So it's 1/3. You see, it's reduced by 1/3. You just have to find that fraction. just reverse it. This time this is sale, but still you are not losing control from 80 to 75%. So everything is repeated. The only difference is NCI is increased here. That's it. Rest everything remains same. You don't have to calculate goodwill, no profit or loss. Still the difference will go to other components of equity. Okay. The only difference is NCI increased here. That's it. This is also not a transaction. Okay. So still you can keep on continuing to consolidate the subsidiary. Okay. Let's save. So now NCI will increase. Okay. And this is same. This time the process that you have received. The difference between the process received minus the increase in the NCI. Because you are disposing, so you will be receiving. So everything is same. No profit or loss. No goodwill is recalculated. The pro forma is also same, except this is cash proceed received, so cash will be debit, and this is increase in NCI, so credit. Okay. The increase in NCI will be the share of the net asset always. And goodwill, fair value method only of the subsidiary at the date of disposal which the parent has effectively sold to the NCI. Okay. And goodwill of the fair value only of the subsidiary at the date of disposal which the parent has effectively sold to the NCI. If the NCI increased from 20 to 30%, okay, that means the carrying amount of the NCA must be increased by 10%. So the subsidiary is net assets if using the fair value goodwill method. So you have to understand that if NCI increases, your goodwill also will increase. Okay, because you are using NCI to calculate goodwill. And opposite for this, when NCI reduces, goodwill will reduce. So we have lots of questions in this area. You don't have to worry at all. Next, subsidiaries that are acquired exclusively with a view to resale. That means you're going to sell the subsidiary. You bought the subsidiary for a short time. You want to sell it or resell it. Then it is not exempt from. Remember, if you have bought it for resale, you cannot still exempt it from consolidation. You still have to keep on consolidating it. It is not exempt from consolidation. But if it meets the held for sale criteria in IFRS 5, then you have to do these things. You cannot keep on consolidating that time. Then it is presented in the financial statements as a disposal group classified as held for sale. Okay, you have to write it held for sale. This is achieved by amalgamating all its assets into one line item and all its liabilities to another. Okay, so you add all assets and all liabilities. It is measured both on acquisition and at subsequent reporting dates at the fair value less cost to sell. So I am measuring this both on acquisition and also at the subsequent reporting dates at this amount, fair value less cost to sell, because IFRS 5. Okay. So the held for sale criteria in IFRS 5 include the requirements that these are the requirements, okay, according to IFRS 5 that you should meet for it to be called as held for sale. What are the three conditions? Subsidiary is available for immediate sale. It should be there for immediate sale. That means within 12 months. And also sale is very highly probable. And within 1 year it will be disposed from the date of the accusation. Okay. A newly acquired subsidiary which meets this held for sale criteria automatically meets the criteria for being presented as a discontinued operation. Okay. Now, disposal of an associate. When you're disposing an associate, when significant influence of an associate is lost, that means it is becoming less than 20%. Let's say 30% is there, now it's becoming 10%. So at 30% they were an associate, but at 10% you are dealing under IFRS 9. So here significant influence is lost, not control, significant influence. Then what happens? Then that investment has to be derecognized, right? That investment in associate has to be derecognized because no more associate now, and recognize what according to IFRS 9. And any shares that are retained will fall within the scope of IFRS 9, and this will be recognized at fair value. Because influence is lost, profit and loss, same way how control is lost, you have to calculate profit and loss. Same way when influence is also lost, significant influence, you have to calculate profit and loss. Okay, and this is the way to calculate disposal proceed. With that you add the fair value of retained interest. Same way for control also. Okay, this is the same thing which is repeated when it was a subsidiary also. Okay, okay, so here you have to deduct the carrying amount of the associate at disposal date. That's it. Next, group reorganization. What is reorganization? Reorganization is like you're changing the structure and just trying to reorganizing it. So if any of this is there, it is known as group reorganization. That means transfer of shares in a subsidiary from one group entity to another. Okay, they are all part of one group only, but you're transferring a share from one subsidiary to another subsidiary. It's just like the shares are transferring hands, that's it. Addition of new parent entity to a group. Third, transfer of shares in one or more subsidiaries of a group to a new entity that is not a group entity but whose shareholders are the same as those of the group's parent. Combination into a group of two or more companies that before the combination had the same shareholders. Acquisition of the shares of another entity that itself then issues sufficient shares so that acquired entity has control of the combined entity. So this all you can just read through and understand. It's not so difficult. Now let us go to reorganizations and the individual financial statements. Right? Yes, much is not left. We have almost come towards the end. So parent may reorganize the structure of his group by establishing new entity as his parent. They might change the parent sometimes. Right? They might make a new entity as a parent of the group. So this is a way of restructuring or reorganizing, you can say. So in this case, what should you do? As long as certain criteria are met, the new parent records the cost of the original parent. Okay, records the cost of the original parent in a separate financial statement as the carrying amount of its shares of the equity item shown in the separate financial statements of the original parent at the date of the reorganization. Okay, so the new parent is recording it as a cost of the original parent. Okay, in its separate financial statements, in the new parent's financial statements, not in the group. So the criteria that must be met, what is that criteria that must be met? The new parent obtains the control of the original parent. They are getting the control of that original parent. That is more than 50% by issuing equity instruments in exchange for existing equity instruments of the original parent. So they are issuing their equity instruments in exchange for the original parent's equity instruments. It's like share for share. Next, the assets and the liabilities of the new group and the original group are same immediately before and after the reorganization. Then the owners of the original parent before the reorganization have the same absolute and relative interest in the net assets of the original group and the new group immediately before and after the reorganization. So it's more like reorganization does not have so much of a huge impact. Okay, before and after the impact remains the same. It's just you are changing the hands. So the above rule also applies when an entity that is not a parent establishes a new entity as its parent. Okay, still you can apply. Now coming to the consolidated financial statements. Assuming that all subsidiaries are 100% owned, a group reorganization generally has no impact. Okay, it has no impact on the consolidated financial statement. This is what you have to remember. This is because assets and investments are being moved around within the group. They're just changing hands. All they are in the same group. It's like I'm giving my asset to someone, I'm taking someone else's liability. It's just they're changing hands. That's it. The owners are changing hands, but assets and liabilities, they are remaining within the same group only. So there is not no change, no impact. Okay. So now let us summarize what we went through, and then next I will be talking in the next video, part 2. I will be going to all test your understanding. So disposal. Okay. If there's a, you have to calculate a gain or loss if you have lost the control. So this is the way to calculate gain minus the, sorry, the proceed minus the cost. But if there is no loss in control, okay, that means no gain or loss when the control is there. But if the control is lost, you have to calculate gain like this. But this is only for the parent entity. Remember that proceed minus cost. But for the group, this is the pro forma that you have to follow. This pro forma. Okay. Proceeds plus fair value of interest retained minus net assets, goodwill, and NCI disposal. This pro forma, you need to memorize it. So coming from there, we'll go through this line, this step accusations a little bit later. First, let us finish this branch. If the whole shareholding has been disposed, okay, then consolidate to disposal and show group gain. You don't include the subsidiaries net assets, okay? You have to consolidate till the date of disposal and show the gain, the group gain in the statement of financial position. If there is no loss of control, then what do you have to do in the P&L and what do you have to do in the statement of financial position? Oh, sorry, there's a mistake that in the P&L you are consolidating to till disposal and showing group gain. In the statement of financial position, net assets are not included. Okay. If there is no loss of control, okay, in the P&L you consolidate for full year. Okay, and you have to but you have to calculate NCI before and after the disposal, that increase and decrease in NCI. And in the statement of financial position, you have to consolidate like normally only. Okay. But you have to record one more thing, that gain or loss to NCI in equity. It has to be recorded because NCI will change, no? So within equity, you'll be recording it. That will change. That will be then the statement of financial position. Then what if the associate shareholding is retained? That means associate is still an associate. So you have to consolidate to the date of disposal. Okay. Then when a subsidiary is becoming an associate, you consolidate until the date of disposal. Then you have to use equity accounting. Okay. And show gain. In the statement of financial position, equity accounting you have to use when it becomes an associate. But before that, you can consolidate. Next, if it's a trade investment, that means IFRS 9. When a subsidiary or an associate, let's say a subsidiary is becoming, they are losing control and less than 20%. That means you have to use IFRS 9. So you have to consolidate till the date of disposal in the profit and loss, and you have to include dividend income and show gain. In the statement of financial position, you record the retained investment at fair value at disposal date. And if the subsidiaries are acquired for resale, then you must consolidate them and present them as a disposal group and measure them at the lower of carrying value and fair value. Fair value less selling cost. Okay. So this is like a summary. Step accusation. Step accusation is like parents are acquiring control over stages. Not in one go, but in several stages they are acquiring that control. Still they are having that control. And remember that when It's a discontinued operations. According to IFRS, you have to disclose that discontinued operation. Okay. At the date of acquiring control, revalue the existing equity holding to fair value and recognize gain or loss. Goodwill is calculated at normal debt as control is acquired. When you have acquired the control, you have to calculate goodwill. And acquisition of further shares, when you're acquiring further shares, after you have acquired that control, goodwill you don't have to remeasure. Okay, then it will be accounted for in equity because that is known as decrease in NCI. Okay, so that's it. See you in part 2 with the questions related to step accusation and disposal. Till then, take care.